All right, guys. So welcome to the part 2 of the one setup for life. All right, one setup for life. So this is part 2. I think the first part was more of the theory aspects, right? We focus more on theory. All right. So we're going to still do some recap based on what I said on the A plus setup. This video will not be long as you expect. It should not be long because we've already done something on the theory aspects. So the one setup for life basically was talking about the pattern where you see the market give you what? A bullish structure, right? Let me do that again. So it simply talks about the market giving you a defined range, right? The market giving you what? A defined range, right? The market giving a defined range. And then coming back to that original area. So this is what we're talking about in the previous call, right? We're talking about the market giving us this pattern, right? And we said that this leg is what we call the external liquidity, and the top is what we call the external liquidity. Then this low in between is what we regard as what the inducement, right? Or the C leg, right? The B leg, sorry. So this is the pattern we're talking about for a bullish scenario, that the market always leaves some kind of inducement before the original POI. The purpose of this is so that people will be trapped into buying this. Some people would likely see an order block inside there. They'll be like, okay, this is another block. Some people will see double bottom. So all those things that people are seeing for, so whatever reasons, that is the reason why this setup is formed. So this low is formed to induce buyers to get into the trade before markets come to what the original what area of what accumulation. Why is it the original? Because this is where the buy started. So you highlight where that buy started, right? The last down move before the buy started. That is where you're looking to enter your trade, just below the inducement, right? So some people always asking me what qualifies an order block. So what qualifies an order block is the presence of an inducement. So that is what we call an A plus order block, right? A presence of an inducement, right? That's what qualifies an A plus order block. So presence of an inducement. So I'm not saying that there must always be an inducement, but when you see an inducement form before an order block, it refers to that was an A plus. So that is what I mean. So it kind of makes it A plus, meaning that it's high probability, right? So that area becomes your point of interest, and then you're looking to take price higher. So that is it. So this is basically what we're talking about. And we also said in the part 1 that not every takeout of a low is a bearish break. What do I mean? Not every that price takes out a low that makes the bearish. Some people would have seen this as what a break of structure to do what to go short, and then they tend to go short at where probably this other block created here. Some people like, okay, let me go short at this point here. Trying to go short here, and then what happens? Market takes them out. The reason is because this whole move is what we call engineered liquidity. This low is an engineered liquidity. It is there to trip you into taking a trade. And when you take the trade, the market takes you out. All right? That is the purpose of it. So I want you guys to always view the market from a perspective of other blocks created after an inducement. So whenever the market creates another block, you like to see this market fail to cap in properly. Sometimes it might just give a partial mitigation. Like I told you guys in the previous call, I talk about what's called partial mitigation, where the market taps the other block shallowly, in a shallow fashion, and then does what? Runs higher. The market now coming back or deeper. So it doesn't matter if the market taps or not. So it doesn't really matter if it taps or not, right? So then I can tap it very just little, but very quickly. It won't stay there, just run off. So that is still valid, right? So this is what we are looking at. Right? This is the whole idea or the premise behind it. Right? Now, I want to give you guys the alternative, or this A plus setup has what we call an alternative fashion, right? And that's what we call the QMR level. So QMR is also another way to take this trade. So QMR is a bit just slightly different, right? So in a QMR pattern of trading this, you are not looking at the order block. You're looking at this level, right? This is the level you're looking at entering your trade, right? That's just the difference between in the A plus level. So in the QMR level, you're looking at this low, right? So QMR, you're looking at this as what is support level. So looking at this low that that engineered this original accumulation. So this is what you're looking at. So QMR level is simply what this area. So you're taking your trade off this previous low before the original swing low. You understand that? Remember, let me come again. The previous setup we know is that we are looking at the last order block after the inducement, meaning that we're looking at what this last down move, could be the last candle, could be the last down move, could be the imbalance, whatever, or the last demand zone here. But in the QMR level, you're not using that, you're using what this low. Right? That is what you're looking at, this low here. That is what you're looking at, the low formed here. That is your area of interest. And that is why you're taking your trade off. So if you're using that QMI level, you're simply putting your limit at that level. Stop loss have to be at the overall low. You should know that. So has to be at the overall low. And then you're looking at what targeting what this high here. So you're targeting this high for your take profits. Right. That is what the QMI is all about. So that's just the difference, right? It's still a one setup for life. So you can choose to work with the QMR or you can choose to work with the other block, right? So it depends on you, right? The one that you see best or see fit for yourself. All right. So the reverse is also the case for a bullish example. So a bullish example now, the market obviously does something like this. Market runs high, right? Breaks below, gives that inducement, and then comes back to that POI. Right. So this is just the same thing that happens here. So now you're looking at this as an inducement, this as your inducement. Sorry, let me take that off. So looking at that as an inducement, right, and then you're looking at possibly the last up candle or this zone. So the unmitigated candle in this zone now becomes your area of interest. Remember, this is what we're talking about, the one setup for life. This is it, right? So now, if you're using the QMR level, QMR is not the whole area anymore. QMR is simply selecting what this point. So it looks like a basic head and shoulder pattern. So it's basically a head and shoulder pattern. So look at that head. So now this is going to become your entry. All right, that's just the difference between there's an alternative approach to trading this one setup for life, right? So the KMR level, you're looking at this level. Why without the KMR, you're considering the last order block printed here, like the last candle, the last order block printed. So that's just the difference, right? I've introduced QMI level now. So just does the difference. Either you're using the QMI level, this point here, or you're using what? The order block printed. So those are the two alternatives, right? Those are the two alternatives, right? That is basically it, right? And remember that this setup is the same for lower time frame. So whatever you see on the higher time frame is the same thing on the lower time frame. So in the lower time frame can also use the same thing too. Markets comes there, you look for what your setup, right, to take it toward the low. So if you're using QMR, you simply do what highlights this area that we are entering, and then stop loss will be above the original high, and then you target for the C leg, which is this leg. All right, that is basically what this is talking about. All right, so that is it. So I think now we have, with what I've explained so far, now we can kind of go to look at real life examples, real life examples. All right, so just give me a moment, let me just spot some real life examples. All right, so let me just take this off so you guys can see real life examples. All right, so let's look for real life examples quickly. All right, so a classic example of this formed on the British pounds US dollars. All right. So now let us look at this whole market structure very carefully. We had what we're talking about. So this is a Richard's example now. So now, first things first, what do you have here? We have the market make a high and then break below, right? So what do we have here? We had an inducement form here. This is our inducement, right? And inside there is a kind of supply zone there. All right. It's kind of supply zone inside there because this candle took out the liquidity of the previous candles. And if you go to maybe 1 hour chart, you'll see it more clearly. So you see very clear in the 1 hour. So like this candle, okay, this is supply zone now. Let us just highlight that supply zone. This is a very, very clear example of what I'm talking about. So this particular candle took out liquidity. So that's a supply zone there. A supply zone there because look at why it's a supply zone. Just look very carefully. Pay attention to. Let me just take this off so you guys understand what I'm talking about. So the candle opened there and then ran the high of the previous candles. And then what happened? Market went lower. So that's what makes the supply zone. Supply zone usually, to me, it should take out what the high of the previous candle and then same price lower. Right. So there's one of liquidity sweep inside it. So you cannot simply highlight where that whole thing happened. Market opened there and then pushed price upwards. So that's a supply zone, right? So that's a supply zone. Although I don't trade much of demand on supply, but I know a lot about it. So we had that supply zone there. So look at the higher time frame now. So we won't say too many candles. So the supply zone was printed there. And then what happened? We had was a break of structure to the downside. And if we check the higher time frame, we are bearish on GBP pound. So on GPS. So let us confirm that on the daily very quickly. So let us confirm if the market is bearish. So it's very clear that market is bearish on the daily charts. So on the weekly, because the market is very, very bearish. So on the weekly chart, very, very careful, very clear. So we have this, you can see market closed below this swing low. We had a break of structure here, market came back. So these other blocks, we are rejecting off this other block here. You can see we are very, very bearish on this guy. So we are very bearish on this particular guy. We are bearish on this guy, right? So we are bearish on this guy. So market is playing on this other block. I know the broker is different. On my own other broker, market tapped into this area. So market is okay, let's use the low of the candle. So can see market is actually playing on the other block, right? So 4 hour told us the same thing. We had that break, and then if you go to the daily chart, we also had another break of structure, signaling bearishness. Where did we have it? Market closed below this low. So high was another break of structure because market went below what? A daily low. You can see this high formed, market closed below this low. That was a bearish break. And not only that, we had what? This bearish other block as well. So had a bearish other block as well created. So there was reasons why the market should go down. All right. So now we have understood the higher time frame premise. So what do we have there? It so happened that on the lower time frame, we had that inducement form there. We had that break to the downside, and then our market came back into that area, and then it fell off the face of the earth. That was a very clean trade, very, very clean trade. Right. So let's quickly check the let's see if we have gotten a lower time frame entry. So yeah, I think we did. So we had a lower time frame entry as well. Although for me, I wouldn't have taken this because I would have loved to see price take out this low. But like this, if you look at this market range now, this was the obvious low, right? I'd love to see price take out this low. I think we had an NFP here. So I'd love to see price take out this low before doing anything. But regardless, we had what a change of character. Markets closed below this low. So the market closed below this swing low here. So, and not only that, we had what an inducement form on the 5 minutes as well. So can you see how these things are lining up? So I had another inducement form here. See the inducement. Remember that last pullback before the original zone. And then what do we have here? Another supply zone. So you can see another supply zone was printed here. All right. Although market did not tap it improperly, but that was it. Okay. And I told you guys earlier in the part one of this call that on a lower time frame, price mustn't always come to the supply zone. You can simply take your trade off the top of an inducement. And I told you guys you cannot take your trade, just put your sell limit at the top of an inducement and then put your stop loss above. I told you guys that before. So it doesn't necessarily have to be that you will take your trade at the supply zone. I told you guys you cannot put your limit above the inducement, just above it is enough. And then put enough stop loss to So that would have been your trade. And that would have been your trade if you did it that way. So that would have been your trade if you did that way. That was above the inducement there, right? Or if you want to do the QMI level, this is also so this is a QMI level now. Because taking a trade of this point, this is a QMI level. But the reason why we're using this is because this QMI level is below the inducement, right? So this have been the best play. Just pay a limit above the inducement or at the inducement, and then stop loss above the high. That would have been the trade. So market took at this short-term low. That was a change of character. But for me, I would have loved to see price take out this structural low because this is the overall low. This low is dynamic low, right? But that is still correct because all this happened inside the 2 hour supply zone. So all this is happening inside the 2 hour supply zone. So for me, if I was to take this trade, I would have likely reduced my risk. All this happened inside the 2 hour supply zone. So if I was taking this trade, I would have likely reduced my risk, like make it half risk, so that I wouldn't have much to lose if it does not go my direction. So that's basically what we had on the British pound. So let's look at. Let me see if I can see one example one. Let me just use a pair like I don't really trade. Let me use a pair like GBP AUD. All right, let's use a pair like GBP AUD. See if there's something of any interest that we can GBP AUD. So if you have not liked this channel, do want to like this video, subscribe so you can get more content like this. It helps our channel when we see those subscribers piling up. It really makes us very, very excited, right? So let us quickly look for, we see something similar like I just explained, because this is a one setup for life. You can be your only trading model. So let's just click on the 1 hour chart to see if we can find it. So let's quickly look for it and I will show you guys. Right, so we had another one set for life here. Market was bullish. Why is it? Because market was broken highs. So market was in a bullish range. What do we have here? First things first, market must be established bullish. We had our inducements here. Told you guys it must see an inducement, and I told the market must not can tap the other block twice. Market actually tapped into this other block the first time, but it didn't give that deep one. So we still had that ABC pattern form. So that inducement taking markets came back there. Now, if you took this trade off, I told you guys that you can always take a trade at the low of the inducement. Right, so just simply put your limit at that point there. That would been a very nice place for your trade. Just limits below that inducement and then stop loss below. That would have been a very nice trade. Targeting was this high. That would have been a very clean trade. This was a 1:4.6. Very easy. Very, very easy. All right. So if you took the QMI level, you are still incorrect. So here's our QMI level now. This is it. So you took this QMI level as an entry. This last, you're using the body of the body of the candles. Right. So this is the body of the candle there. So you can still use that QMI level to enter as well. So that have still been a nice trade just there. The QMI level. You're using the body of the candles, right? So just the body of the candles, just the body of this candle. Put your limit there and then that is it. All right. So for me, I like to play other blocks. I just put my limit below the inducement. So that is basically it. Right. It's very, very easy to spot. It's a one setup for life. So if you enjoyed this video and you want to see more content like this, do how to like, subscribe, and drop your takeaway. What is your biggest lesson in this video? And if you want to join our paid mentorship, it goes for a one-time fee of 50,000 naira. Just use the link in the description to join our paid mentorship as well. So there's no more discount for this year. We're not forcing anyone to learn. So it mustn't force you. If you know you want to be part of us, just pay 50K for 1 year. It's less than $40, about $35 currently, and you can be part of us for 1 year. So I would love to see you guys in the next video. Have a wonderful day. Cheers and God bless.